A stop loss order limits the risk of a trade. It is actually the best friend of a trader who wants to survive in the market and realize his long term potential profits. Most traders actually find comfort in having stop losses to protect them. At least they know the importance of keeping a stop loss to protect their position from risking too much of their capital. But what most traders don't care about is that they do not give much thought to how they set their stop losses. So, in order to truly realize the benefit of having stop losses, you must adopt a logical mindset. But before we discuss how to set stop losses from a logical standpoint, let us take a look at how not to set stop losses so that you get a clearer picture of what I'm talking about. With the help of two questions, I will summarize the wrong thought process for setting stop losses. The first question is how much money is okay for me to lose in a particular trade. The second question is what is the implied stop loss price that I should keep? Now, coming to the former question, let's say for a particular trade, I'm willing to limit my risk to 1000 rupees. Now, imagine I'm buying 100 shares of a stock ABC at rupees 100, and in order to limit my risk to 1000 rupees, I must now place the stop loss at 90 rupees. Now, you may ask me, what is actually wrong with this thought process? The problem is that it disregards market price action completely. In the process, we have determined the stop loss level as 90 rupees purely based on our risk preference. But to the market, this stop loss point is random, arbitrary, and completely meaningless. If you keep your stop losses with this thought process, and given the volatility and stop loss hunting by smart money, most often or not, your stop loss will end up being hit. Now, let me talk about the more logical way of placing stop loss orders. As a logical trader, your thought process should take you through the following questions in the particular sequence. Number one, what is actually my logical stop loss price? As I have mentioned, our risk appetite does not imply a logical stop loss point. A logical stop loss is one that is highlighted by the market price action. The benefit of these stop loss levels, which are based on price action, is that it allows us to limit our risk while giving the breathing space for our trades to move up and down. From my preference, there are actually two primary methods for finding stop loss points using price action. The first method makes use of supports and resistances in association with candlesticks for stop loss determination. Ideally, we want the market to stay away from our stop loss point. The support and resistance levels, as you know, can be quite useful. A major support level is where we expect buying demand to come in, and a major resistance level is where we expect the supply to hike and thereby leading to a sell off. Hence, for our long trading setups, using support levels as the base for setting stop losses is quite logical. The same goes for using resistance levels as the base to set the stop losses for short trading setup. Now, the support and resistances can be stationary, as in case of pivot levels, Camarilla, Fibonacci levels, etc. And it can also be dynamic in nature, as with moving averages and trend lines. Just keeping the stop losses below the support level or just above the resistance level will not save you from the giant wicks that search for liquidity in form of retailer stop losses in today's markets, which is often known as stop loss hunting. To stay ahead of this, we have to consider the candlesticks also. Most often, if you're looking for a particular reversal trade from a key support level, then your stop loss must be placed below that candle that has the deepest wick or rejection. Personally, I like to place my stop losses below the pin bar candle with a very deep wick, which means that most liquidity in that area has been absorbed by the smart money. And on most occasions, if the trade starts moving in your favor, the chances of this stop loss being hit reduces significantly. Now, the same idea goes with a short trade from the resistance level. But make sure that you have done the right price action analysis. Don't just make silly mistakes like going long from a support level when the market is forming a descending triangle consolidation pattern at the level, which has a sure shot possibility of breaking below the level and hitting your stop losses. To know more about different price action concepts, I have already made a free course on all the important topics. You can check them out on my channel. So, in short, set your stop losses based on an area of value with an emphasis on price action and the nature of candlestick that is formed. Now, the second way of setting your stop losses is by considering the volatility in the market. As I have mentioned, an ideal stop loss is one that offers enough space for a trade to move up and down to some extent without failing our analysis. For example, a stop loss for a bullish flag pattern is placed below the lowest of the consolidation candles that form the flag. In this case, your stop loss will be hit only if your analysis goes wrong or if your entry was too early. That is, the breakout did not sustain and came back down to hit your stop losses. Now, another important question arises. How much space or price range is enough for the price to freely move without hitting our stop loss? Now, the answer depends on the market's volatility. So, here is another logical method for setting stop losses that takes into consideration the volatility of market price action. The classic example of a volatility stop loss is Chandler's stops. Now, it is an indicator that uses average true range or ATR, which is a measure of the market volatility. And then it places the stop loss based on a multiple of the ATR value. If you want to know about the ATR indicator, I have already made a detailed video on it. You can check that out. Most of the time, I use the 14 period ATR with a multiplier of anywhere between 1.5 to 3 for our Chandler stop. Now you can adjust the multiplier value according to the market volatility. That is, if the volatility is very high, go for a higher multiplier, and the opposite if the market volatility is very low. Another important thing about the Chandler stop is that it can be very useful as a trailing stop loss. You can ride the move as long as the Chandler stop loss is not hit, thereby maximizing your profits. Now let us come to the second question. How much money should someone risk based on the logical stop loss point? Let's say, for instance, a price action pattern associated with the logical stop loss implies a risk level at Rs 40, and we intend to enter the stock at 50 rupees with a total quantity of 100 shares. Now here we will need to risk 1000 rupees. Now ask yourself, can I afford to risk that amount? There can be two scenarios for this particular case. The first scenario is where you are a limited capital trader. That is, you only have 5000 rupees in your trading account. And that is all the amount that you can use for trading activities. And if you lose it, you can no longer trade. And if you lose the 1000 rupees as implied by the pattern, you run the risk of suffering a 20% drawdown. Clearly, you cannot afford to take the risk. In this case, regardless of the trading setup's quality, this trade is too expensive for you. Either you must pass on the trade or scale down your position size to lower the trade risk to an acceptable level. The second scenario is when you have 1 lakh rupees in your trading account and 1000 rupees is just 1% of your risk capital. A loss of 1% will not ruin your ability to continue trading. And as a matter of fact, you can afford to take this risk. Hence, you can take the trade. So at the end of the day, it all comes down to risk management and position sizing. To sum it all up, a misguided trader starts his personal risk preference and then proceeds to place a stop loss in the market. He has already decided that he wants to enter the market before evaluating his actual risk. He completely neglects the market. On the other hand, a logical trader considers the market risk before deciding if he wants to enter the market. He starts with an analysis of the market for potential stop losses. Then only he considers his individual risk preference. Ultimately, he enters the market only if he is able to bear the risk, or else he will pass on the trade. So do keep in mind that stop losses limits your risk and are critical to a trader's survival. However, if you do not set your stop losses logically by placing the market first, they are actually pointless. I hope the video was useful for you. If it gave you some insights, please do like the video, share it with your friends. Don't forget to subscribe to the channel and enable the bell icon so that you won't miss out on the upcoming videos. I will see you guys in the next video. Till then, see you.